So today we're talking about why banks cannot operate in multiple industries. Why can't banks, commercial banks, sell insurance or provide security services or underwriting? Why can't a commercial bank be an investment bank? And the story actually extends all the way back to 1960s and 70s. And there's one significant event that happened in 1974, which kind of started the entire global effort to regulate banking altogether. Since we realized that the commercial banking is integrated internationally, and that any reasonably sized bank failure leads to a contagion effect. G10 countries came together, and then later on, this expanded into an actual, a committee to regulate banking internationally. And the signatories to the committee and to the agreements are known to be part of the international commercial banking community. The effort is done in Basel, Switzerland, and therefore these are usually considered or called to be Basel Banking Accords, Basel Banking Accords. So this is, why banks cannot, sell insurance, or why banks cannot maintain, for instance, real estate portfolios, and I'm providing all these links as part of our lecture discussion. But anyhow, so when the Herstatt Bank in Europe failed, this kind of started a ripple effect around the world, which led to a discussion of the commercial banking failure contagion. And we then have, we then have the initial discussion of the Basel framework. The first one is happening in 1988, and the committee of the Basel, after the failure of Herstatt Bank, included the G10 countries back then, but now it's expanded to include pretty much all the signatories of the Basel Banking Accords. So what are the Basel Banking Accords? So before we go into the details of individual accords, which we actually have three of them, and they are ever evolving, let's talk about the structure of the committee. How its governance is taking place. So this is not a regulatory body. It's not like Fed or a central bank. This is more of a the bankers getting together in a way, countries getting together to create a banking, not laws, but rules by which the bankers have to live by, and the banks can be held accountable for, and they're intended to avoid, the banking crises that we had in the past. And we had several of these. In the 70s and 80s, we had in, Thailand, in Korea, in Turkey, Mexico, Argentina. I mean, we had banking crises in the last few decades, especially in 2007 and 8, when we had the banking crisis in Greece, which, the contagion was towards Europe and even in the Middle East. So, the idea is to contain them and to make sure that the systems do not become unmanageable, or the crises do not become unmanageable. And when we talk about contagion, we don't necessarily talk about countries that are neighbors to each other. For instance, from an international banking perspective, when we talk about developing countries, um, a country like Turkey and South Africa would be within the same basket simply because they're both developing nations. And therefore, they don't need to be neighbors to be or to create a banking risk for each other. But anyhow, so with respect to the Basel Committee, it actually has a chair and it has four groups. The first one is the Risk and Vulnerabilities Assessment Group, and then the Supervisory Cooperation Group, and then the Consultative Group, and then Policy and Standards Group. And they report to the group of governors and heads of supervision. And then there's the Secretariat. But again, I want you to understand that this is not a central bank where the Basel Committee does not control money. They don't have any intervention powers. They don't have any regulatory powers of their own, and they do not actually enforce any laws or rules of their own. However, you have governments and central banks that are part of or signatories to the Basel regulations, rules, and they themselves enforce these rules to maintain a safer banking system. And this way, if we have everybody enforcing the same set of rules, then we have less of a commercial banking crisis risk. And these, the rules, the first one is in 1988 called Basel I, and then 2004, it's called Basel II, and then 2009, which is actually ongoing, we have the Basel III. And they're ever evolving. I'm not sure if they actually call it Basel IV now, but Basel III, as it was actually first came about in 2008 and 9, and then in 2017 there were amendments, and those amendments were significantly different than what they had in 2009 and extended it significantly. So it's an ever-evolving process, and obviously the risks that commercial banking is facing are also ever-evolving, and therefore the banking rules obviously has to catch up or to cope with this changing risk structure, changing market structure. So let's start with Basel I and see what it is all about. So with respect to the Basel I summary, remember this was in 1988, and it was almost immediately after one of the major European banks have failed dramatically. And there was the understanding of a need for a unified banking rules. So this was the first attempt. So in this one, they kind of created a foundation of what absolutely needed to be done, right? So I think the most important aspect of this were that the assets were classified into categories according to the level of risk that are associated with that. And this right now, after we discussed all the asset management and liability management, and the reserves since the beginning of the semesters, sounds like, of course this needs to be done. But imagine, before 1988, before the Basel I came about, banks were pooling all their credits and all their deposits into what we call asset pools or liability pools. So, the credit cards and, mortgages or larger commercial loans would all go into an actual credit pool. And from the pool, the banks used to set aside reserves, but it was all dependent on the country, dependent on, the banking regime that the country employed, and it was not universal. And there was no understanding of, or there was no, I mean, there was an understanding, obviously, but there wasn't an accepted set of rules that meant or implied that higher reserves need to be set aside for higher risk assets. And every bank had to keep a certain amount of cash at hand. There has to be a reason to fractional banking, and then whether the banks could keep, treasuries or government bonds in in lieu of cash or in their reserve accounts. And so with Basel II, I think the main suggestion or the main rule was that the banks were now required to, create uh, sub pools and classify or categorize their risk, their assets based on the level of risk associated with that. So, as far as I remember, when I was in banking, we had to keep about 7% or so cash. And this included the actual cash at branches, actual cash at our reserve accounts, actual cash at our correspondent banks. And that led to a lot of cost. So, from a bank perspective, because cash does not earn any interest, but your liabilities, your deposits, you actually incur cost. You want to actually use all your money and interest bearing risk. And obviously, that's not the way to go. So, from a bank manager perspective, I feel like I should be allowed to use all my money and invest in high interest bearing securities or risk. However, this leads bank to fail and that leads to contagion. So, with the Basel One, the intent is to take this, um, you know, decision from the managers of banks and make it a regulatable, if you will, an item of regulation by central banks. And, the banks are subject to providing statistics to their central bank. And through these classifications, central banks were now more able to assess risks faced by banks. Um, we also have, again, Basel One was a limited uh, first attempt at creating a foundation for the set of rules that will lead to Basel II, Basel III, and then the evolving of Basel III. I think the second major issue with Basel One was that the banks now were required to keep, right here, banks now were required to calculate a total capital ratio. We talked about this capital integrity, capital adequacy ratios, where you have your tier one and tier two, and Basel One, they also introduced tier three. Um, looking at how much capital, how much paid in capital that you have, divided by how much risk-weighted assets you have. Um, but there wasn't a set minimum for the banks. Every bank calculated it. Okay, fine. But some banks had 1%, 2%, and then some of them had 10%, 15%, and the competitive environment. So as banks become more and more competitive, you actually are bound to have less and less ratio, which means um, banks are becoming overextended in their credit utilization, their asset expansion, their leverage. And so Basel One set the minimum at 8%. And that's actually quite significant. So that's actually quite significant. Um, again, you're talking about, so say, for every $100 million of credit that you assign, you have to set aside about $8 million of paid-in capital. Like you have to have at least $8 million of paid-in capital. While to me it's significant from a bank safety perspective, it probably is a bare minimum, and that I would assume that many of the countries establish higher capital adequacy ratios. So another important issue with Basel One was that before Basel One, the items that are considered to be off balance sheet were not included into the risk or the asset structure. So what do they mean? So for instance, when a bank actually gives out a credit, um, that is an asset and they actually write it on their balance sheet. However, sometimes a bank makes a promise, say a conditional promise. Let's say, if you complete this uh, construction, then the bank will pay you $10 million. But you see, there is a condition. If you complete the construction, then we will pay you the the X amount of dollars. So as long as there is this if condition, the banks used to consider these as not actual credit, and they're called off-balance sheet items. So these are unused commitments or letters of credit, letters of guarantees, performance guarantees, derivatives. They're all in the future, but we promise them today. And therefore, as long as we're promising them today, but there's not an actual exchange today, an actual payment of money, actual extension of credit, then they don't actually go into the balance sheet as assets. And however, they're real. When the contractor completes the construction, the bank made a promise to pay. Very similarly with options or futures or credit derivatives or swaps, interest rate swaps, the bank has to honor their commitment in the future that they actually agree to commit today. And these off-balance sheet items were ultimately and universally almost not included into the total capital adequacy ratios. With Basel One, they were pulled into the balance sheet and they became part of the risk or part of the asset structure. And I think that these 3 points make the Basel One significant. First, the assets were classified into categories by risk, and then the total capital adequacy ratio minimum was set to be 8%. And then we also pulled in the off-balance sheet items into our asset structure. So, but after 1988, we had multiple banking crises around the world. And in some countries, we had multiple. So it wasn't enough. And so there was a need for further regulation or further set of rules to be discussed, to be employed. And in 2004, there comes the Basel II. But the Basel II extends the Basel I, and this is the IMF that actually goes through in detail what Basel II comprises of. So, but mainly Basel II is a lot more robust system. And remember, this is approximately 20 years after the first one, approximately. And many countries have had significant liquidity crises, and which led to many bank failures and the regulators and central banks having hard time and deposit insurances having hard time to maintain orderly commercial banking. So there was a need to extend the fundamental foundation of commercial banking rules and to provide a little bit more detail as to how to enforce some of the existential risk for commercial banks internationally. So we have 3 pillars for the Basel II. The first one is all about the minimum capital requirements. Remember, we actually set the 8% previously, but now we try to bring in a little bit more explanation and requirements as to how we calculate the risk basis. It's never about how much capital you have, because what you paid in capital is a set amount, but it is always about how much risk you take, given the paid in capital you have. So with the paid in capital, you're leveraging yourself as a bank, and the risk you take with that money has to be in relation to the paid in capital you have, so you don't expose the bank and the entire banking system into an excessive risk. And obviously, you want to leverage as much as you can. However, there has to be a limit. So, what is the loophole? What's the flaw in the first Basel? Well, remember, at Basel One, we categorize risk assets by risk categories. But who decides on these risk categories? Who decides what's risky, what's low risk, what's high risk? In the Basel One, it was fundamentally the bank itself. So if you have a malice by bank managers, then you have over simplified systems that define even the excessive amount of risk as simple risk. And unfortunately, this can actually be a system that can be abused. And therefore, we need to set some guidelines as to how this risk is defined. And this has to be universal. So we come up with simple standardized approach, and then we standardize by using external credit rating, and then internal rating based approach, and then advanced internal rating approach. And in a lot of the cases, you can actually have, especially for say commercial paper, like for instance, for individuals, how we have credit scores, we actually have credit ratings based on individual borrowers for companies. But then what about for the companies that doesn't have it? What about for banks extending credit to each other? And then, so we basically rely on the supervisor of the system or the regulator of the system to provide. So we basically externalize the rating of risk. And therefore, like I said, there never is a dispute about how much capital you have. It's always the dispute is about how much risk you're taking with the level of leverage you are trying to extend yourself. So the second pillar, remember I said the Basel II has three pillars. The second pillar is recognizes the supervisors. So, originally it was all set of rules suggested by the Basel Committee, but there wasn't an actual set regulator. The central banks obviously are the ultimate regulators, but they have to be spelled out. And it also had to be that certain statistical data flow was maintained from individual banks to central banks and to perhaps some sort of a banking regulatory authority. So in many countries now, you actually have banking regulatory authority, including the US, where you maintain license information, maintain risk information, and then the Fed, as the ultimate central bank in the US, maintains banks, ensures banks' ultimate exposure to the markets. And obviously, the deposit insurance, like FDIC, is a significant regulator in a way that if a bank is excluded from the FDIC, they would lose their viability. And therefore, FDIC, by becoming almost a required insurance, becomes a de facto regulator. So with the second pillar of Basel II, the banking system is now set to have a supervisor that will review the banks on a regular basis, and they might actually require higher levels of capital. They might require more data. They might require actual access to bank data. They might, in some certain circumstances, sit on the boards and actually have control over certain decisions at the bank. So, for instance, in later on in Basel III and on, the argument is that if there is a significant what is it called? Yeah, large exposure. So the regulators can actually veto such large amounts of exposures. And the process obviously doesn't work like, they sit on the board and they have a vote. No, but it's more like regulators preemptively can set rules independently to ensure that the banks do not take significantly focused and concentrated exposures to single borrowers that would expose the bank and the entire banking system to excessive risk. So we now, with Basel II second pillar, we now set an actual supervisor for the banking system. And pillar number three is basically creating a market forces for banks to behave. We now require banks to provide transparency in their financial reporting, and for them to provide significantly more data, and therefore the clients, the customers, the borrowers, and credit agencies can have access to this extended financial data, and therefore self-regulate. And I think personally, I think that this is one of the most important um, in rules that the entire Basel system have introduced, simply because the market forces can actually create banks or make banks behave in a very competitive and sometimes in a very risk-taking, courageously risk-taking behavior. And now that we have to become transparent in our asset, liability, capital structure, and liquidity management data, now we want to go, yes, greedy, and we want to be as risky as we want. However, we are now also concerned that because the public will know about it, we may want to be a little bit careful about it. So I think that the two major pillars of the Basel II, setting a supervisor and making the market become a self regulator, are major changes in banking as we know it. And like I said, the Basel II happened after significant number of banking crises around the world, and in some countries more than one, and several banks have gone under, and therefore there was this need of defining who the supervisor is, defining what needs to be public, and defining how banks can create that transparency to public. And after this, we actually come to Basel III. So the Basel III came about in 2009 in response to the financial crisis of 2007 and 9. However, this is an ever evolving set of rules. And some people refer to this as the end game, the Marvell's end game. Now, this is the banking end game. And however, I think that the second Basel II pillars were the most important and universally, groundbreaking rules about supervision and about transparency. However, Basel III sets certain requirements. Like, for instance, we now have a definite capital requirements for market risk, and now we are going a little bit more into detail. So unfortunately, I can't cover this in all in one video, but to give you a summary, now we actually have defined levels of risk and how much reserve that you have to have, how much paid-in capital you have to have for each level of risk. So instead of just saying 8%, now we're saying for this type of risk, this is what you're supposed to have. For this type of risk, this is what you're supposed to have. And therefore, we go into a little bit more detail. We also introduce what we call a stress test. We require banks to come up with a scenario analysis in case a certain number of their assets fail. What would happen to their capital ratios, their liquidity ratios, their liability structure? And we require banks to do this on a regular basis. And this allows the central banks, the supervisors, to assess the upcoming risk and prepare accordingly. And therefore, it gives the Treasury and the central bank a heads up, or a deposit insurance a heads up as to what can happen if inevitable changes do happen in the commercial market or in the economy overall. We also have leverage ratios that are defined with the Basel III. We literally define, how much credit cards, how much, mortgages, how much, triple A, double A, junk bonds, and so on and so forth, different levels of risk you can actually take, given your paid-in capital, given your liability structure, given your credit structure, asset structure, and liquidity structure. We also now define for the first time liquidity coverage ratios, and this is a significant change. Um, the idea was that, in my opinion, that even the 1974 issues and bank failures after that were all ended up becoming liquidity, crises. However, neither the Basel One or the two defined actual liquidity requirements. There was always the definition of the banks need to set aside X number of percent for cash and the cash-like items, but never an actual definition of a liquidity coverage ratio. So with the Basel III now, we define an actual liquidity coverage ratio for commercial banks. We also define, like I said previously, large exposure or non-diversified asset management definitions into the Basel banking rules. So, for instance, as far as I remember, when I worked in banking in Turkey, our central bank extended the requirement of this large exposures, and we had actually a definitive percentage of our paid-in capital. We set the maximum that we could assign a credit to one particular or one single borrower. So, for instance, if you're talking about, say, out of 10%, if your paid-in capital is $100 million, then central bank can say that your largest exposure to one single borrower can be no more than $10 million. So in a way, the supervisor is, or the regulator is forcing you to diversify and giving you a maximum amount that you can allocate to individual risks, which again makes sense because one of the biggest problems that banks do, or biggest mistakes that banks do, is to go with the easy route. They actually have a good borrower and it is a single borrower and it is easy, it is cheap, and they already done the analysis. So why don't we give all our asset, all our money to them and get on with it? And what happens when that individual borrower goes under? Well, you go under with it. Or that's the extreme case. What happens if that particular borrower has financial trouble and they want to renegotiate? Well, then, because it's a major borrower, you really don't have much of a leverage with them, and therefore you will end up caving. So, as a bank now, you're at the mercy of a few borrowers. So, with the maximum exposure requirement, the Basel III sets the diversification requirements for the bank's credit portfolio. Basel III also sets rules for securitizations. We had this issue with the AIG that I explained Wednesday, and it is a significant issue. We really do not want a similar securitized loans to becoming portfolios and becoming sellable assets like mortgage-backed securities, which is still significant securities in the market, and we still go through the same amount of risk. However, now we are more regulated and therefore a little bit more transparency and obviously more diversification. And again, at least we are now cognizant of how much risk each bank is exposed to with respect to the exposures, the securitizations, the liquidity, the leverage, and the capital requirements. And the Basel III again is significant in the sense that it is, it's ever evolving. And what it came out in 2009 and what they're still working on, there is this issue of as the markets and market risk and banking evolves, technology especially evolves, so has to, so the rules have to evolve. And so some people refer to Basel III as the end game, but I think that there's a lot more to it. Um, Even in 2017, um, actually, even last year, they came up with more amendments and implementation suggestions for regulators, and it's been about 12 years since it was first introduced. Um, so, but again, you can actually see here the pillars that we discussed in Basel two, and how with Basel three you're simply extending on the Basel two. So with Basel one we had the foundation. With Basel two we started to have the supervision and then have the market regulating with the transparency. And then with Basel three, now we have a little bit more definitions of requirements as to the capital leverage, exposure, liquidity, and securitizations. And so that's about it with the Basel and the banking history. And I think that Basel is a significant point that became, especially after COVID. So many banks are having issues with um, the Fed increasing interest rates, and therefore their asset structures, asset managements are being exposed to unexpected and unprecedented risk. Um, so again, thank you for working with me, and I appreciate it. And if you have any questions, please let me know. Thank you. Bye now.